welcome to this edition of Money Matters TV. I am your host today, Shelly O'Donovan. I'm from a company called the Authentic Influence Group, and we do all things influence in companies. We go in and train folks in how to harness their executive influence, their executive presence, both in pharma and medical device, and sometimes we even work in the financial services business. So I am excited today to be joined by my co-host, Ken Jordan from Round Point Financial. And Ken, I would just ask you to give us a quick introduction of yourself for us today.
Sure. First off, it's great to see you again, Shelly.
Thank you.
Ken Jordan with Round Point Mortgage, originate residential loans, refinances, purchases, cash out refinances, and essentially, any home financing needs that you have.
Excellent. Thank you. So I have a question for you today,
Sure.
Ken. So I'm just really interested. I'm hearing that a lot of people are talking about this cash out refinance. And I wonder if there are some do's and don'ts that you can give our listeners about that.
That's actually a really great topic, Shelly. So cash out refinances, for those that don't know, are when a borrower owns their home, they have a value, let's say $300,000, and maybe they only owe $150,000 on that loan. Well, that gives them about $150,000 worth of equity. In a cash out refinance, a borrower would take out a new loan for, let's say, $250,000. They would pay off what's left on that $150,000 first loan. They're left with a new loan of $250,000, and the proceeds, after you factor in your closing costs, is what comes back to the borrower that they can use for a number of things. They can use it to pay off debt. They can use it to pay for a life event. They can use it. They can use it to do repairs to the house. It's essentially money that they can use for whatever they want. But there definitely are some things you want to keep an eye on when you're doing a cash out refinance. And one of them is the value. Unfortunately, until you have an appraisal by the lender that you're working with, you really don't have much to go off of except for online websites that give you an idea of what your values are. And those can be a little bit difficult to, they're not always accurate. Let's just put it that way. So you might have more equity in your house than you think, or you might have a lot less equity in your house than you think, depending on the website that you're going to and the credibility of that data. The other thing you want to keep an eye on is the cost. When people are refinancing their mortgage to lower their payment, cost conscious is part of the game. How much am I really saving? It seems that when people are taking out a mortgage on a cash out refinance, monthly payment and costs sometimes does get overshadowed by what it is you're doing. Maybe you're paying off debt and you're paying off a car loan and you're saving $450 a month. So, the increase in your mortgage payment's marginal, saving the money per month, that's all great. But you still got to keep an eye on the costs, and you want to make sure that you're talking to your lender about, what the interest rate is, whether or not you're paying points, and what potential add-ons there would be on your mortgage for, let's say, credit score, or ultimately the loan to value ratio, or how much you're borrowing against your house. That's one thing you really want to keep an eye on.
Interesting. Yeah. And so tell me what other kind of pitfalls that folks get into. Is that something that they know up front, or do they have to do quite a bit of research before they get to the point to know that they could be in that situation?
Yeah, you should. You'll have to take some things into account that you don't know yet, like value, and in some cases even credit score. But most lenders, when you're talking to a lender and you give them, okay, I think my house is worth X. I think my credit score is 750. That lender should be able to give you a pretty good idea of what the cost of the loan are going to be. Granted, when you finally apply, if things are different than what you had thought they were, down, you might find that some of that stuff might change marginally, but overall, that's something you really should be able to find out on the front end. What is the interest rate? What kind of points are we looking at, if any? And that'll give you an idea of how expensive the loan is.
Okay, interesting. And so, and you're seeing a lot of this. Do you think that's just with the housing market booming so much, or do you have any insights there?
So a couple things we're seeing, a couple reasons why we're seeing cash out refinances. One is the values. For a long time, houses, coming out of the real estate meltdown and that those fun couple of years, you didn't have a whole lot of increase in value. So now we're starting to really see values go up, increasing the equity position in a borrower's home, and that's giving them the opportunity to borrow against that equity. But the other thing we're seeing is because the market is so strong right now for sellers, buyers are finding they're going out to look at houses to buy, and the ones that they want to buy are either overpriced, or they're the third person in and the house is already sold, or there's bidding wars. There's all kinds of challenges for buyers right now. And people are saying, okay, well, why don't I take a look at where I'm at? Maybe I can do some remodeling and make where I am what I want it to be. And I think that that's driving some of the popularity of the cash out refinances as well.
Interesting. That's really interesting stuff. I have a brother-in-law who just moved back to Ireland, and they have a crazy housing market there too. And they bought a new house kind of sight unseen, just from, what they saw online. And then they sent somebody else to go look at it, but they haven't even seen it yet. So I just think, it's really interesting what's happening, all those ups and downs that are happening in that housing market right now.
Yeah, it's a roller coaster at times, for sure.
Yeah, absolutely. So I think this brings us to our question of the day. So Jack Walker from Philadelphia has asked, what good is title insurance, and do you have another option? So I'll throw that to you, Ken, because you're the expert over here.
So Jack, that's a great question. Title insurance serves a very important purpose. So when you buy a house and you're taking out a loan, for instance, the mortgage company, for one, wants to make sure that there are no liens, encumbrances, or clouds on that title. So they do the title search, and the title company will do the title search and make sure there's no mechanics liens, make sure there's no tax liens, make sure that the person that is actually selling you the house actually owns it, whether it be through an estate situation, and they ensure the lender that there are no issues with that title. If someone comes along and says, hey, I have a mechanics lien, on this property and it needs to be paid, the title insurance company is going to pay that claim. Now, owner's title insurance is optional. The owner's portion of the title policy insures the owner for the equity. So if you're putting 20% down, the title portion of the premium is 80%, and then the owner pays a 20% of the title premium for their coverage and their protection. And while it does say optional, I've yet to have a buyer opt out of taking the owner's portion of the title policy for the amount of money that it costs. It doesn't make any sense to leave yourself that uncovered for potential clouds or issues down the road. Because if you find that there is a cloud on the title, let's say you buy a house cash and you decide, hey, I'm not getting title insurance. Well, when you go to sell the house, that could be an issue. So it's really an insurance policy, not only to make sure that there's no liens, but also that when you go to sell the house, that the title is clear for you to convey to the next buyer.
Excellent, thank you. I hope that Jack enjoys that answer, and I'd like to give you an opportunity as our viewer to think about how you might submit a question. So with that, I'm going to shoot it over to our promo so you can see how you can submit a question here to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
So with that, I would like to introduce our guest for today. And Len, if you'll join us, this is Len Getz from the Tax Resolution Philadelphia. Thank you so much for joining us today.
Well, thank you very much for having me this afternoon. It's good to be here. It's good to meet you.
Absolutely. So will you tell me first, just give me a little introduction and tell us what you do, Len?
So Tax Resolution Philadelphia, we prepare tax returns, federal tax returns, state tax returns, city tax returns. We also represent taxpayers if they're called in to the IRS for an audit. You don't want to do that by yourself. And we also represent taxpayers who have outstanding tax debt, so tax resolution. We try to resolve those outstanding tax issues. It could be anybody from an individual, corporation, or partnership.
Excellent. So that's really interesting to me. And my first question is, how do you avoid a tax audit? Because it just sounds like a tough experience to have to go through. So how do you avoid that?
Yeah, it's almost like going to the dentist, right? There's something you want to avoid, but you can't. But you have to. It's inevitable, right? So everybody should know that the IRS can really audit any tax return that it likes. But they only have 3 years from the time you file the return to do that. So while they can audit any tax return that they like, there are certain things you can do to try to keep them at bay.
Okay.
Certain things you should keep in mind to do. So first of all, you should report all your income. Don't leave anything out. The IRS has a way of matching information returns, and if they, for example, a W-2 or 1099, and if they don't match us on the return, it could be selected for audit. People who actually have either a lot of income or very little income, that's a target too for the IRS. And you think that because you have very little income, well, why would they audit you? Well, it's because maybe there's income that you didn't report. So that could be that could raise a red flag. You should also make sure you have no excess or excessive deductions or credits. That could raise a red flag. Make sure it's in line with the type of income that you have. Schedule C filers should be very wary of being audited because there's a lot of deductions that you're allowed to take. You're absolutely allowed to take if you're in business for yourself, you're allowed to take certain expenses, auto expenses, supplies, depreciation, but you have to make sure that you have documentation for it. As long as you have the documentation for it, then you should be good. There are certain things that they look at in particular. For example, travel and entertainment is an item that they look at closely. Mileage, keep a log. Always keep a log if you use your car to travel from place to place. That's always very, very important to maintain. Also, if you do drive a vehicle and you have no other vehicle, then you should not be taking 100% business use of your vehicle. And the question is, well, what do you do the rest of the time? So,
right.
Let me ask you a question. Are there different types of audits?
So yeah, that's a really good question, and there are. The simplest audit would be a correspondence audit, where, as I mentioned before, the IRS may match the information that they have in their system with your tax return. And if they see a difference, let's say they see there's a 1099 that's missing from your tax return, they can send you a letter, and they say this is a correspondence audit that we want to see. Make sure that you've reported all this income that we have on our records, but you don't seem to have. And it's very possible that you did report it. You may not have indicated that it was a 1099 income, but you may have. You may have reported it. So that's good. There's office audits, and then there's field audits. But these days, in the environment of COVID, there are almost no office audits or field audits, by which you're asked to come into the office to present documentation, or they come out to you. They can come out to your home or your business. And there's actually some corporations that have IRS revenue officers, revenue agents at the site all the time. They're constantly auditing them. But so these days, most of it's done by correspondence, by telephone, and faxes. So those are the different types. And the IRS can audit the deductions on the return, but they also could look at income. They can also try to reconcile your income. And if they see that if they believe that for some reason you have more earnings than you're reporting, that could be a red flag. And by the way, usually when they send you a letter saying what you're being audited for, they'll tell you exactly what it is. We want to see your mortgage interest. We want to see your charity contributions. But once they're out there and they look at it, they can have the option of expanding the audit if they feel it's necessary.
So they can look at something and see, be looking for something completely different, but then they see another anomaly and they're like, all right, we're gonna go down this road too.
They can do that. Now, what they won't ask you to provide right then and there. What they'll give you is an IDR, or an information document report. We're going to expand this, and this is the items that we want to see, and they'll give you some time to gather that information. And with regard to income, that's a little bit tricky. And with income, the IRS has the burden of proof. For deductions, you have the burden of proof because you're the one who's stating it. I'm saying this is my deduction, so then you have the burden of proving it. With income, the IRS has the burden of proof. Now, they have to prove that you don't report all the income. So what they may do is they may do something like a bank deposit analysis, and they'll see all the money that's being deposited into your bank, and compare that with what you have on your return. Now, of course, everything that you deposit in your bank is not taxable. They could be transfers, they could be gifts, various things. So they weed all that out. And once they weeded all the stuff that's obviously not taxable, then they can compare it. And if there's a difference, they say, well, you have more income here that you reported. Why is that? And then you may have a income adjustment that way. So so there's a lot of things they can, they have a lot of tools at their arsenal to in order to determine whether you've actually reported the right amount of income.
So let's say you do get called that you're going to get that audit. Unfortunately, what's the first thing you do? Like, how do you really prepare to walk into that audit?
Right, that's a really good question. You don't want to go in there blindly. You just want to go in there with a shoebox full of receipts. Some people do that. They say, well, you're the one who's, you want to see what I have? Here it is, a shoebox. You don't want to do that. You want to make your life and the agent's life as simple and as easy as possible. So you should have all your documentation in a nice neat pile. You want to have it organized. You want to show them that they say to you, we want to see your charitable contributions, let's say. Well, here's my receipts. Here's my checks. Here's my checkbook. And it all reconciles to what's on the return. That's really basically that. And you should be cooperative. You definitely should be cooperative and show up on time. And if you don't feel like you can do it by yourself, you always have somebody there. You can always bring somebody with you. Like your accountant or somebody that's representing you.
Len, let's say the audit doesn't go your way, right? And
right.
And you disagree. Is there a way to appeal an audit, or is it final?
Right. So the first thing that the auditor should tell you right away is that you have a right to appeal. They tell you that right at the onset of the audit. So what they'll do is, what the agent will do is, he'll do his work. He'll reach his findings, and he'll send you a revenue agent's report, basically his proposal of taxes, about outstanding taxes, and I'll present that to you. And I say, here's what we found, and you can do any number of things. You can say, yes, I agree, or I say, no, I don't agree. Well, if you don't agree, he sends you this letter. It's called a 30-day letter, and you have a right to appeal it to an appeals officer. So these are the items that I'm appealing, and you respond within 30 days. You respond to that letter saying, I am protesting the items I'm protesting the agent's report. And then you will have a right to a hearing with an appeals officer. Now, an appeals officer, even though they work for the Internal Revenue Service, they're actually in a company. Their division is called the Independent Office of Appeals. So they are really charged with taking a fresh look, an independent look at the results of the audit. So that so you can go in there and say, well, I disagree with what the agent did, and here's why. And the appeals officer will look at your documentation, hear what you have to say, take it into consideration, compare that with what the agent reported, and see if there's what the taxpayer is saying makes that whole sense, and what the agent did does not make any sense. So what the appeals officer can do, he can do one of three things. He can actually say to the taxpayer, "You're correct. There's no change in your tax return. You don't know anything." Or he can say, "I'm sorry, but looks like the agent is correct. You don't have you haven't presented me any information that would refute what he has to say." Or you could say, "You know what? There's a gray area here. It could be a matter of facts. It could be a matter of tax law. It could be maybe they see the law in different ways. That's why there's tax court. There's lots of different ways of looking at some positions that you may take on a tax return."
Same reason we have underwriters in our world, I guess, right?
That's right. Everybody has an opinion. So what a appeals officer is allowed to do is look at the hazards of litigation. So what are the chances that if this goes forward, that the IRS will win, or the taxpayer will win? What are the chances? And so he used that hazard of litigation, and I'll say, you know what? I think there's a gray area here. I think what you have to say is, I think you have a case. You may tell the taxpayer you have a case, but not as good as the other case, as the IRS's. So you may say to him, I will concede, let's say 30% of the tax. And you can, or he can say, you know what, you made some pretty good points here, but I think the IRS has made better points, and so I'm going to sustain it 90% in the IRS's favor. And oh, by the way, with regard to preparing for the appeal, you should always, if you bring additional information at the appeals office, he will send that information back to the agent. Because remember, what the appeals office is doing, he's reviewing the findings of the IRS's agent. And if the agent didn't have that additional documentation to make a ruling on it, well, then the appeals officer can't rule on whether the agent made a mistake or not.
Yeah.
So you should always send all your information, always present it first to the IRS agent before you go to appeals. Because the appeals will say, oh, sorry, he has to get the first look. He or she has to get the first look, and it'll go back. So that will that's great. That will take more additional time. So all right. So now we're at the point where maybe they can offer us, he can settle the case either by reaching a settlement with the IRS. And if you don't settle it, if you disagree, you actually have another way of doing something called post appeals mediation. It's another level of challenging the IRS. And what that entails is the IRS then brings another appeals officer in, and the taxpayer also has the right to bring in his own mediator.
Now, Len, would that be someone like yourself, or would they be hiring an attorney? Who would help them in that situation?
It could be someone like myself. It could be an attorney. He has to have the option, but it would be a taxpayer's expense. It would be a taxpayer's expense. So he would. But that would really be what he has. But he has that option, and it's interesting. It's an interesting dynamic because, as I mentioned before, the appeals officer is independent, but once you're in that post-mediation scenario, he's now sitting in the seat of the IRS, and now he's the one who's being challenged, right? So, and some of these cases go on for a long time. They could,
So tell me if you have outstanding taxes, and I will give you a warning that we're nearing the end here, but if you have outstanding taxes, can you tell me, what's the best way to handle that?
Okay, so number one, the IRS has a lot of tools in its arsenal to collect outstanding taxes. They can issue a notice of levy, garnish wages, filing final lien. Before they do any of those things, they have to send you out a collection due process letter. And that gives you 30 days. It gives you 30 days to respond. If you respond to that letter within 30 days, then you're entitled to a hearing in front of a appeals officer or a settlement officer. And if you do respond within the 30 days, you actually secure judicial rights. So, if you can't resolve it with the appeals officer, then you can go to court. So basically, there's three ways you can settle the case. Settle outstanding debts. You can pay in full, you can reach a part payment agreement, an installment agreement, or an offer in compromise. You might see some things on TV about an offer in compromise, but where you can pay like 40 cents, 30 cents on the dial. It's possible. It's not the first thing they look at, but it is possible. It is out there. So,
and they'll give you an opportunity to pay that over time, typically.
Absolutely. Yeah, installment agreement, you do pay over time, and you should know that the IRS cannot go after you forever. There's a 10-year collection statute. So if you're like say close to the end and you want to have a resolution, let's say you owe a lot of money, and the IRS determines that you can pay X number of dollars per month, and that won't pay it off within this collection statute. Well, then you'll just pay that amount within this collection statute, and the rest of it will be discharged.
Wow,
that's a possibility too.
Excellent.
Yeah.
Excellent. Well, I just want to say thank you. We're actually out of time today.
Oh, okay.
Thank you for taking the time to come and talk to us here at Money Matters. I'd like to also thank my co-host, Ken Jordan from Round Point Mortgage. And join us next time when we'll be talking to Jeffrey Stello of Charlestown Capital Growth Partners, LLC. Thank you.
All right.